Welcome to the overview of Chapter 19, Chapter 35 in the book. This is looking at foreign exchange, balance of payments, and the open economy of macroeconomics. Thank you for joining me as we go through the overview of this chapter. We're going to look at balance of payments, as I mentioned, the idea of foreign exchange and the foreign exchange market in relation to the exchange rate. We'll also look at current accounts and financial accounts. We'll see what impact they have on the trade deficit in terms of what we hear about in the news all the time. We'll also look at the idea of exchange rates and how sometimes they are fixed and sometimes currencies float in terms of those exchange rates and the impact that may have on them. And then we'll consider the open economy approach to looking at these exchange rates and the impact that it can have. Now, there are a number of explainers on foreign exchange I think you'll find helpful, so do check those out from folks like You're Gonna Love Econ, Jason Welker, Jacob Clifford, and ACDC Econ, as well as Khan Academy. So some great explainers in addition to what we're going to talk about here in this video. And I would encourage you to check those out. Always helpful to get a second opinion. Let's start by talking about balance of payments. This is the idea that we have different transactions taking place around the world. These are things like buying and selling goods and services, trade, investments in different accounts, as we've discussed before, and investments in real estate, in financial transactions, taking an ownership stake in businesses. These are all part of the balance of payments accounts that we look at within the macroeconomy. Current account would include things like goods and services. The type of goods and services that we buy every day would be included in the current account. And the merchandise trade balance is a frequently cited component of the balance of payments on goods and services. Nothing specifically there you need to know, just to know that it is included when we talk about goods and services, buying things. It is included in the current account aspect of the goods and services we see there. Financial account is a little different because this is more investments. So these are things like investing in businesses, investing in businesses, corporations, ownership stake in things that you may own, buying assets like real estate or property, other types of things like that. Would be included in the financial account category. So a new business that is created and an ownership stake sold, that's what would be sold there, and that would be included in the financial accounts as opposed to current accounts. So they do need to balance. The current account should be equal to the financial account so that there is a seesaw effect of balance here. We can see that when there is investment in bonds or real estate, other equities, that is in the financial account, and that should balance out with the current account, the idea of goods and services being traded, transfer payments and whatnot. These are equal. They are a seesaw in their very nature. So if we look at the example that the text gives, the idea of a business looking at how does balance of payments, how would it work for them, where is their revenue coming in and where are their expenses, cash going out. This should be equal. So when we look at sources of cash, we can see artichoke sales, interest on their money in the bank, and then funds from a new loan. All of these count towards sources of revenue, sources of their cash flow at 125.5. Now, where do they spend this money? Well, the farm operation and living expenses we can see is 110. The interest paid on the mortgage about 10,000, and different funds deposited in the bank. They're taking that money and putting it in the bank. And again, the uses of cash balances out to 125.5, leaving a net of 0 because those payments, those accounts should balance. The idea of expenses and revenues should balance in that regard. That's how a business would conduct capital flow in terms of their balance of payment. And a country is no different. When we look at a country in terms of how it's also not quite so nice and neat as a business could be in terms of balancing assets and liabilities. But if you look at balance of payments in the United States, we can see here that current account in this example is actually negative, and it would be trade deficit because we don't make lots of goods anymore. We buy them from countries like China or Malaysia or Indonesia, where it's a lot cheaper to make those items because labor is cheaper and resources are cheaper. And so where we make it up is in financial accounts, in assets and equities and real estate portfolio investments, that sort of thing. So financial account is actually greater here, leading to a positive balance in the financial account category, meaning more money is being invested in those financial accounts than we would see in what is being traded in current accounts. And that would not be surprising that it would balance that way. Which also means that the trade deficit mantra is kind of a misnomer in a lot of cases because of the fact that you have current accounts, things you're buying, going out the door and going to another country, but a lot of investments also coming into our country in terms of what's being purchased. Now, that doesn't always happen from year to year. You can see in this model more goods and services are being made and sold to the United States, and so the balance of payments here does show a deficit in terms of what's being purchased. Financial accounts in equities and investments is actually lower than what we saw with current account, the trading of goods and services. But the idea here is normally it's going to swing the other way, and maybe in 2009 it was a net positive for financial accounts, and in 2010 it's kind of balancing that out. So you have to look at the broader long run approach to these balance of payments as well. So what we look at here is it is U.S. In relationship to the rest of the world. We pay for the assets to the rest of the world for assets that we purchase, and then they pay us for assets that they purchase. There is a back and forth there, kind of the blue lines that you see. And then the yellow lines, we're paying for the goods and services, and then they're paying for our goods and services. And to say that we don't sell any goods and services would be a miscalculation. But the idea is it is a flow, very much like we talked about the circular flow way back in the beginning of micro and the beginning of macro. There's still a circular flow here in terms of in terms of goods and services and assets being purchased around the world as well as here in the United States, and being sold vice versa in terms of those relationships. This is a really good exercise in terms of looking at the balance of payments and the transactions taking place. Is it a debit, meaning money owed, or is it a credit in terms of money that's coming in? And you can pause this video here and check on the next slide to get the answers to all of these. But this is a really good exercise. You do need to know the difference in credits and debits and current account and financial account. And here are the answers to those that exercise in terms of what is a credit versus a debit. Remember, debit is money owed. A credit is money coming in. It's revenue. So think of it that way. And anytime there is an investment, that would be a financial account. The idea of goods and services being sold would be a current account item. And you can see here, even in these examples, there's more current account examples than financial account examples, because a lot of cases the current account is cheaper products. You're not selling as much in volume there as you would be in a financial account. An investment in a company can, for $5 billion, that's a lot of goods and services that are being purchased for $5 billion in the current accounts in order for that to balance. So you don't need a lot sold in the financial account category or silo in order to make up the differences there in terms of the seesaw effect, or the equal equation of current account should be equal to financial account in that regard. And we see this all the time, the idea of trade reciprocity, the idea of well, if you're buying things from us, we should be buying things from you, and vice versa, right? A joke being made here about the national debt and treasuries being purchased as a result of all of these the holiday shopping going on, goods that are made in China. But it really does speak to current account and financial account. The idea of buying up debt, securities, equities, also buying investments in companies has a significant amount, and is much greater than a lot of what we see in terms of in terms of the current account, the goods and services being sold. So that takes us back to the loanable funds model, this idea of we have an upward sloping supply curve, downward sloping demand curve, meeting at equilibrium, and the equilibrium interest rate we're talking about here is actually at 4%. So our quantity of loanable funds is meeting at this equilibrium. Now, it's important to note that when our equilibrium interest rate is higher than other countries, it is going to encourage investment. Okay, let me say that again. When the equilibrium interest rate for our country, our U.S. model, is greater than other countries, it is going to encourage investment because people want to take advantage of the fact that the higher interest rate is going to make them more money. Conversely, if the equilibrium interest rate is lower than other countries, we're going to see money leaving the United States and moving to other countries because the equilibrium interest rate is higher there. So a great way to think about this in terms of two countries with two different models, if you see the U.S. having a higher equilibrium interest rate of 6% versus Britain's 2%, what you see here is the capital is going to flow out of Britain and into the United States, and out of a lot of other places and into the United States as well, because investors can put their money into the U.S. economy, into U.S. resources and assets, and actually make more money there. So it is a no-brainer. Think of it. It is logical that we're going to our money, our investment, is going to flow to the country with the higher interest rate. That's going to encourage investment because the rate is higher. So very important to understand that capital flow. Now, what does it do ultimately? What is it going to do? It's actually going to lead us to equilibrium. Now, how we get there is because we have more inflow coming into the United States, which is going to shift the supply curve, the supply of loanable funds. So if you think of it this way, in terms of that supply of loanable funds coming into the United States at that 6% is going to lead to a shift in the supply of loanable funds and bring our equilibrium interest rate down. Our international equilibrium rate becomes 4%. Remember, we were at 6 and Britain was at 2. Now all of a sudden the supply of British currency is actually leaving, because remember, the capital is flowing to the United States. So supply of loanable funds in Britain is actually shifting leftward or inward, leading to a higher interest rate. And that's how we end up at an international equilibrium rate that is equal for both countries. Now, what is that going to do for capital flow? Well, ultimately, they're not going to stay there. Something's going to happen to lead one country to lead to a higher rate, and the capital will flow to that country in terms of where the money is going. But the idea is that's how we get to an equilibrium interest rate in terms of or how we get to an equilibrium in supply of loanable funds based on those interest rates. So foreign exchange is the idea here that currency is going to appreciate and depreciate in the foreign exchange market as it is traded, as it is used in buying goods and services, assets, current accounts, as well as buying investments, real estate, property, equities, securities, T-bills, treasuries in the financial account. So this is the idea of, well, what is the currency worth in relationship to others? Now, for the moment, we're looking at this in terms of a fixed rate, if you will, a fixed exchange rate versus a floating dollar or floating currency. But it's important to note that we also call this Forex, by the way. Forex, if you've ever seen that, or FX. A lot of cases they'll call it FX, the idea of foreign exchange. And this is the idea: when a currency is more valuable, it's going to appreciate. Okay, so when the currency is more valuable, this is an appreciation of the currency, and we'll see the impact that has on trade here in just a second. When a currency is actually less valuable, we will see the currency depreciate, and the reason there is because people are seeing it as less valuable. They want to hold less of it, so they're not going to hang on to it as much as they would if the currency was appreciating. And think of it this way: it's like an investment. If the currency is higher, then people want to hold on to it because they're assuming it's going to continue to rise, and they want to continue to make more money off of that appreciation. So they're going to look at the rate as being more appealing or appetizing because the currency is appreciating. Now, that's not always the case when it comes to trade. We'll talk about that in a minute. But conversely, if the currency is seen as less valuable, it will depreciate, meaning that people aren't going to see the investment as being really worth that right now. And so they will instead look to other currencies in terms of their investments. So the capital isn't going to flow to as much of those places. But I'll tell you, this goes back to the current account, financial account situation, because what will happen is when the currency depreciates, people aren't investing in those places because the interest rate is lower, but they are buying more goods from them. So current account benefits, financial account would not benefit in that particular situation. So if we look at the foreign exchange market, where our three key graphs from this chapter are coming from, and our last key graphs for macro are coming from, we see the supply of U.S. dollars and the demand for U.S. dollars. We see an upward sloping supply curve of U.S. dollars that are at work. We see a downward sloping demand of U.S. dollars because as the exchange rate is higher, the idea is the demand for dollars is lower. And as the exchange rate is the exchange rate is lower, the demand for U.S. dollars is going to be greater in terms of that euros per dollar type of mentality. And this is what we see here. So when we have an equilibrium rate, this is where supply meets demand, just as we've talked about throughout economics this year. The idea is we're looking for equilibrium. And the equilibrium exchange rate is where we find this quantity supplied and quantity demanded at this particular equilibrium exchange rate of euros per dollar. In this example, it's euros per dollar. So a way to think about this then is when we look at buying goods and services, Europe is going to purchase U.S. dollars in terms of buying U.S. goods and services, and that would help the current account. If they bought U.S. assets, that would help the financial account, the third column that we see there. And then the U.S. Selling U.S. dollars in order to buy European goods and services. Notice we're buying more goods and services from Europe. We're buying less assets in the financial account because and they're buying, in this example, equal current and financial account resources. So here's where we see the current account because they're buying goods and services. This will be current account. Here would be a financial account, and we can see that we are buying more goods and services more in the current account space than we are in the financial account space, leading to a balance of payments on current account of negative 0.5 and on the financial account of plus 0.5, leading to a net zero. Again, the seesaw coming out equal in terms of what we see here. Now, what impact is this going to have on the demand for U.S. dollars? Well, that's a great question. When we see an increase in the demand for U.S. dollars, we're going to see an appreciation of the dollar. Demand shifts rightward or outward, and this leads to a movement along the supply curve to a higher exchange rate, to a higher level, and an appreciation of the dollar. It is appreciating in terms of its value. And so what we see here is there is a reason why people aren't buying more goods and services in the current account, because the dollar is appreciating. So it leads to more investment in the financial account, less in the current account because of this appreciating dollar that you would see here in this model. And the same is true of any type of currency you would see that's being exchanged here. Again, the exchange rate being euros per dollar, so you would need to outline on the vertical axis what that is in terms of the relationship to another currency. Okay, so keeping that in mind of this demand for U.S. dollars and the appreciation of the dollar, let's talk about monetary policy here for a second in relation to this exchange rate. So if capital is going from Europe to the United States, then the demand for U.S. dollars in that exchange market, the foreign exchange or FX, is going to increase because people are converting their euros into dollars. And this is going to lead to an appreciation of the dollar. Not, oh, don't you look nice, not that kind of appreciation, but appreciation in terms of the value of the dollar is increasing or improving, if you will. This is causing the balance of payments on the current account to go down, because what's going to happen is if the dollar is appreciating, that means you're going to get less bang for your buck when you buy goods and services, when you buy things from the U.S. market. So it's going to discourage people from buying things in the U.S. market. However, it is going to encourage investment in the financial account because of the appreciation of that dollar. So you're going to see more investment on the financial account side because of that investment. Now, the idea here is if the goods and services in the United States are too expensive because of this appreciation, what it's going to lead to is Americans buying more European goods and services or other countries that are involved with this. Now, for now, we're only looking at this one-to-one, and the only time we're going to talk about foreign exchange in AP Macro is really when we're comparing two countries, no more. When you get into upper level economics courses in college, you'll look at a lot of the variations of multiple countries involved in this, but we are just looking at a one-to-one relationship in these terms, in terms of this appreciation. So as the demand for dollars increases, you're going to see an appreciation of the US dollar. That is going to lead to a decline in the current account, an increase in the financial account. And that would lead us to buy more goods and services, more current account items from other countries. And that leads us to key graph 35, which is the foreign exchange market, upward sloping supply curve, downward sloping demand curve. Notice on the vertical axis we have the yen to the dollar exchange rate, and the quantity of US dollars is what we're looking at on the horizontal axis. They meet at equilibrium, an exchange rate, an international exchange rate that we see here at lowercase e, and a quantity of US dollars in terms of those funds here at Q. Okay, so this is the 4x model, or the 4x market, in terms of what we see here. And if you think of it very much like loanable funds, like we looked at before, that's why we started with that model. You can see demand for loanable funds in terms of demand for dollars leads us to key graph 36. If the demand for US dollars increases, the idea here is supply is going to move along the curve to a higher exchange rate, and this is leading to an appreciation for the dollar. What does that mean? Well, it means the yen is depreciating, because again, if you're looking at two currencies and one currency goes up, the other one's got to go down, and vice versa. So you have to think of it like a seesaw. If the demand for US dollars were to fall and we saw depreciation, then we would see an appreciation of the yen. In this model, we're seeing a depreciation of the yen and an appreciation or an increase in demand for US dollars, leading to an appreciation for the US dollar. So this is what we're seeing in this particular model in key graph 36. Now, if we flip that around, looking at key graph 37 then, if there was a decrease in the supply of US dollars, and we looked at this in terms of capitals flowing somewhere else, if the interest rate is better in another country and so the capital is flowing somewhere else, leading to a decrease in the supply of US dollars, this means that the dollar is going to appreciate, and this is why it's very cyclical, because if the capital is flowing to another country and therefore the investments are flowing there, all of a sudden supply of dollars is decreasing. This is going to lead demand to move along the curve to a higher exchange rate. And now all of a sudden you've got the dollar appreciating in relationship to the yen here in this example. And this is the idea of an appreciating dollar from a supply side perspective. So when the supply is decreasing, again, capital flowing to another country, it's going to lead to an appreciated dollar. And ultimately what that will lead to is a higher interest rate and the idea of the money flowing back to the United States, and the process starts all over. So any country looking at foreign exchange would be looking at this model in relation to the country that they're talking about. And again, that changes from time to time. A really great activity here on the foreign exchange market, if you would check it out, is in the modules section of my MCPS Classroom. It's activity 7-3. Some really good ones here in terms of what's appreciating or depreciating, and looking at this from that perspective. I think you'll find this helpful if you were to look at that particular model in terms of what you see in May and what you see in August, and whether or not these are appreciating or depreciating in this relationship, and I think you'll find that helpful. And again, you can pause the video here before I show the answers to relate to this. But obviously, when we see an increase in the demand for dollars, we're going to see an appreciation versus a decrease in the demand for dollars, a depreciation. And now, if you look here, you can see if the idea here is, you can see that in May we had a dinner for two that cost 500 Mexican pesos, which is $55.05. Now in August, it's $75.10 for that dinner for two. We can see that the Mexican peso has depreciated in relation to the U.S. dollar in terms of what is there. A hotel room that cost 30,000 Japanese yen, and in May it was $249. Now is $270. We can see has also depreciated. It is you need more of it in terms of the dollars demanded. So in the dollars demanded, in terms of that relationship, it is depreciating because you need more of them as a result of what is the currency relationship here. So if you look at the foreign currency in comparison to the U.S. dollar, you can see the dollar has depreciated because of the change in value of what it was worth and is now worth, and you need more demand for that, which means you are going to spend more of your dollars paying for those items, leading to that depreciation. BMW costs 85,000 euros in Germany, and again, now the price is greater. It's going to cost more dollars, which means there's a depreciating dollar on the horizon, which is leading to the greater costs in U.S. dollars. Notice here, in the last one, we'll go through a pound of Swedish meatballs that cost 30 kronor. Was 282 in May, now 279 in August, and we saw this with the leather jacket as well. When the cost actually falls, that's because the dollar is appreciating. The dollar is greater there than what you saw before. So when you look at it in terms of these prices, if the price of how many dollars it's costing for that item goes up, that tells you it's depreciation that is at work, because it's costing you more in that currency to actually pay for the same item that you bought just 3 months ago and you paid less for. And the opposite would be true if the currency was appreciating. If the prices are going down, meaning the value of that currency is going up, that would lead to an appreciation that we see here. And there's a couple of really good activities that relate to this in this particular activity that I think you'll find helpful in practicing on appreciation and depreciation. Monetary and fiscal policy related to the exchange rates. Again, 7-4, another great activity in terms of what impact does this have on the exchange rate of the Taiwan to the U.S. dollar, and what impact taxes or spending could have in those relationships. Same is true with Japan and real GDP, and I think you'll find those helpful. So just some really good activities there. The last one I will mention is capital flow. We kind of talked about where's the flow going based on interest rates. When the interest rate is higher, the capital is going to flow to that country, and you can see that working out here in activity 7-5, which again, we will do some of these in class, but the idea is you'll find it helpful in terms of where is the capital actually flowing. And you can see here again, current account and financial account need to equal. If goods and services being purchased are greater, then there are going to be fewer assets being purchased in order to balance that out. Current account should equal financial account at the end of the day. The real exchange rate, essentially, you've adjusted for the differences, taking inflation out of the picture, so it's real exchange rate, just like real GDP would be. So the real exchange rate, Mexican pesos per dollar, essentially is the price of a dollar in U.S. dollars divided by the price in Mexican pesos. So you want to look at it in those terms. And this is in real terms because we've taken inflation out of that equation. Purchasing power parity is this concept that looking at nominal exchange rates in which you're looking at those goods and services that are being produced. How much does it cost from country to country? Purchasing power parity basically looks at the currencies and the nominal exchange rates to determine what is the actual purchasing power parity between, in this case, Canada and the United States. We can see the purchasing power parity when you take inflation out of the picture is pretty steady versus the nominal exchange rate, which can be pretty volatile based on inflation, based on inflationary pressures that we see there. The fixed exchange rate is what the International Monetary Fund is really trying to get countries to abide by, because it's a lot easier to stabilize currencies when there is a fixed rate. This is the idea that you're targeting particular rates based on other currencies, based on other nations, and the rising tide that lifts all boats can help when it's a fixed rate versus a floating rate. That can be kind of problematic when the government can kind of manipulate the numbers. There was a lot of complaints over time about China's currency being floated versus fixed because it was providing them with an unfair advantage to lower their rate in order to encourage more growth and investment in the goods and services space, encouraging a depreciation of their currency in order to get people to buy more goods and services from them to help their current account and improve trade among those countries. So that really would be the reason why countries would use a floating exchange rate in terms of what we see today. With market intervention, what we see here is if there is a this is the U.S. dollar per Gino. If you look at what the target is, what are we going to have to do in order to get to that target? So if we fix an exchange rate above its equilibrium value, we're going to end up with a surplus. If we fix it below equilibrium value, we're going to end up with a shortage in terms of what we see there. So this is more this is less about what you would need to know for the AP exam, but more in terms of what Dr. Krugman is talking about in this chapter in relation to exchange market intervention, the idea of trying to keep your currency fixed in relationship to other currencies and exchange rates that you see out there. And there are lots of ways to do this in terms of trying to stabilize currency. Fixing the exchange rates is what the IMF really tries again to promote, and getting countries on board with that really helps to stabilize all currencies in terms of keeping people in a more stable environment and an environment in which people can trade between countries because they're more confident in the rates that are being used out there, not just in one country, but in many of them, throughout many of them, in terms of what we see there. We see what's called a devaluation when the currency is less valuable in terms of the fixed exchange rate. We see a revaluation when the value of a currency previously had a fixed exchange rate and now there's an increase in that value, so they're reevaluating that in relationship to that. And again, sometimes this can have an impact on interest rates and obviously capital flow in terms of why countries would want to manipulate that in order to benefit their country and their trade in terms of what's happening there. So cutting interest rates domestically could lead to depreciation, and that would lead to more purchases of more trade in the current accounts in goods and services, which is why countries would like to do this in cutting those interest rates. And then contractionary policy would have the reverse effect. So that would be more expansionary policy, but contractionary policy would have the reverse effect. It's going to lead to an appreciation of the currency. But again, that also leads to less sales of goods and services in the current account space. So you want to be careful there in terms of, and this is another thing that the Fed has to keep in mind when looking at adjusting rates, because that monetary policy can have a profound impact on trade, global trade, with the United States in terms of that overall current account that we're talking about, those trades of goods and services that are being sold abroad. no more do we see this than in this model of kind of the back and forth in relation to the monetary policy. So as the Genovian interest rate falls, Genovians are investing more abroad. Again, the capital is going to flow to countries with higher interest rates. That's going to lead countries to buy more U.S. dollars and sell more Genos. That's going to lead to less investment in Genovia, reducing their demand, and that's going to lead to a depreciation of the Geno. And the idea there is that with this result, they would be able to sell more goods and services if they are at the capacity that they could handle that. But the idea there is that they're going to make it up in current account because they're going to have a lot less investment, even domestically, in their financial accounts as a result. So they're going to want to make it up in current account because they're not making it up in financial account, and that really is that's really the driver here when we see the interest rate fall and the relationship, the back and forth in terms of what we see there. So this is why it's so important with a global economy and the macroeconomy being what it is, why the IMF and the United Nations and a number of countries are really supportive of open economies because they can see where this rising tide helps to lift all boats, helps to improve the standard of living in a lot of countries, and really helping promote trade, and especially with developing countries, promote trade in the current account space, in the goods and services they can provide and produce, and that really helps the standard of living in those countries, the people in those countries, and encourages their further growth. The floating rate, as we mentioned, could reduce the relationship in exports and parts of the business cycle, and their relationship to other countries in that business cycle. And that is it, ladies and gentlemen. That is the end of macroeconomics. You can look at the summary slides here. You can pause the video if you like in order to go through them. They're also in the slides deck on my MCPS Classroom. I hope you found this helpful. There are key terms here as well that I think you'll find helpful. And as we wrap up the semester, just a couple of notes on events and ideas to think about. Here's another concept that we'll take a look at later. The idea of classical versus Keynesian macro. In the classical view of macro, they really do view SRAS as LRAS or LRAS as SRAS. They view them as one and the same, not really very different there. In Keynesian, there is a long-run aggregate supply curve that is vertical. The SRAS curve is more upward sloping, so very different in those mindsets in those models. We see here fiscal policy, taxing and spending. When it comes to fixed money supplies, if the money supply is fixed, the increase in AD is actually going to lead to aggregate demand growth, as we see here on the right-hand side, leading to improved real GDP, but also higher price levels. So when the money supply is fixed. And again, that's the Fed control of the money supply. So if they leave it alone and don't touch it, again, very classical view, letting the markets kind of do its thing, that would be how they would approach it. The increase in money demand would drive up the interest rate is the idea, crowding out investment spending and that kind of thing. So with leaving that alone, if the money supply is fixed, you're going to see money demand shift rightward or outward, and money supply not changing based on, again, the money supply is fixed. So it's leading to a higher interest rate, which ultimately would lead to more investment in the financial accounts space as well. The velocity of money, we talked about this before. How does money turn over? And we can see that turnover has experienced highs and lows, obviously lows in more recessionary times, highs in more expansionary periods, and it really does follow the business cycle in terms of what we see there. Some key questions to ask about macroeconomic policy. from the differing viewpoints we have looked at this semester in terms of the classical approach versus the Keynesian approach, the classical being the Friedrich von Hayek approach versus Keynesian, the John Maynard Keynes approach, and even the Milton Friedman, the monetarist approach, as well as the moderate consensus approach that we see there. So you're welcome to pause the video in order to take a look at those. And again, those are in the slides. We'll close it out with the explainers on foreign exchange. Don't forget to look at the key graphs. And again, pretty straightforward in terms of the foreign exchange model on these. When demand is moving outward or rightward in terms of demand for dollars, that's going to lead to an appreciation of the dollar and in relationship to the currency we're looking at. So in this case, it is an appreciation of the dollar in relation to the yen, leading to a greater quantity of US dollars and a higher exchange rate in that model. An appreciation of the dollar means less current account investments, but more investments in the financial account space because the capital is flowing where the dollar is appreciating in the financial accounts. Not so much in terms of purchases in the current account space. And then if the capital is flowing to another currency or another country for investments, as a result of that, as a result of depreciation, what it ultimately leads to is the appreciation once again, which is a supply of U.S. dollars, just like a supply of loanable funds. If the loanable funds aren't there because the capital is flowing elsewhere, this is going to lead to a shift or leftward or inward of the supply of dollars, leading to a higher exchange rate and ultimately a higher interest rate. That will then bring the money back. It will bring the money back to the economy in terms of that financial account space. So we see the money go out, we see the money come back in, but again, current account should equal financial account in the long run, in the end, in terms of what we see there. Also, don't forget about the take-home quiz study questions, as you'll see here. And again, the answers with explanations are also on my MCPS Classroom. Do check those out. There's also sample questions for the previous chapter, Chapter 8, which is Unit 6, the old Unit 6. And then this chapter, Chapter 19 or 35 in the book is actually Unit 7, the old Unit 7. And these are the answers to the sample questions that are there. These are great practice questions just to get more in front of you before the summative test coming up this weekend. And that closes out our last chapter in macroeconomics, if you can believe it. This is it, our last overview of AP macroeconomics. So I hope you found it helpful on Chapter 19, Chapter 35 in the book, looking at foreign exchange, balance of payments, and the open economy under macroeconomics and global trade. I hope you found this helpful, and we will see you in the review sessions. Take care.